Welcome to Financial Freestyle. I'm Ross Mack, and this is sponsored by Vanguard. Welcome to Financial Freestyle here on Yahoo Finance. I'm your host, Ross Mack. Now, look, guys, no matter where you are in your financial journey, you always got to take a first step. And that's why I'm sitting down with some of the most influential people in finance to learn about their paths to economic success. And today, I'm literally sitting down with the Sarah Kuntz of Cleo Capital. Sarah, thanks so much for being here. How are you doing?
I'm good. How are you?
Phenomenal. I see not see, but you told me you're in London. How's it over there?
Yeah. Spring is just slowly starting to come, and I know I shouldn't say that to you in Chicago because it is probably still very cold there. But spring has started to bloom, which is always fun.
Yeah, well, that's a subtle flex because it is currently snowing as we speak.
Oh no,
But
I'm
to the
sorry.
audience, yeah, no worries. To the audience, who is Sarah? Who is Sarah Kuntz?
Yeah, so I run Cleo Capital. It is a early stage venture capital fund. So I invest in technology startups from the earliest points of their development. And I started that in 2018. I started my fund Cleo Capital in 2018. Prior to that, I had worked inside of startups. I had worked as a startup founder and operator at startups. I'd worked for venture funds, and then way before that, started my career in fashion at Chanel. So I am somebody who likes to keep busy and find innovation, and I love what I do now in venture.
So wait, you started in the beauty industry. Well, not won't say beauty, but you worked at Chanel, so call it the retail industry. How did you kind of shift and get into the venture world?
Yeah, it was interesting. I had always been drawn to kind of newness and innovation. And, this is now sort of post iPhone, post social media. We're all kind of in that on the internet. But before, that was quite as ubiquitous. It felt like the way to kind of find cool new stuff was to see where culture was moving, right? Whether that was sports, at which I am terrible, or fashion or art or things like that. And so that's really kind of what felt like, hey, this is what drives the trends. This is what drives culture and where people are looking to see sort of what's next, what's new. And
Right.
so I ended up in fashion and beauty because of that. But then right around that time, 2008, 2009, the iPhone came out and technology and Facebook had started to be this big thing that wasn't just a couple, kids on college campuses. And so it started to be obvious to me that actually the consumer internet is a thing that is happening, and there's a lot of cool innovation there. Even though I'm not somebody who particularly enjoys coding and being an engineer, I can still go do things in this space. And so I jumped over first to media technology, and then slowly just kind of kept working my way deeper and deeper into technology.
I love it, right? Starting out in, fashion and beauty, you obviously have to spot trends. And I think that would obviously echo and why you're, successful in your venture world. So earlier you said, right, you from a venture standpoint, I just want to better educate the audience. You are investing in early stage companies, right? Can you kind of break that down and give the audience a sense of like what that looks like?
Yeah. So, I invest in the earliest stage companies. That might mean that somebody comes to me and says, hey, I have a really interesting idea. I do a lot of financial technology. So somebody might come to me and say, hey, I have a really interesting idea for a new way to, keep your crypto safe from hacking or, to be able to do like Venmo style transactions with friends in different countries because you can only do that sort of sort of frictionless financial money movement with somebody who's in usually your same country. And so they'll come to me with an idea. They might have still a full-time job. They might still be in grad school or something, but if they're really interested in it and they've been putting in work on kind of nights and weekends, and they have something to sort of pitch to me, a pitch deck to show me, and I like it, I might write them a check so that they can quit their job and get started building. And so no company really is too early for my fund to look at. And then those companies go on to become, big, much bigger. I'm invested in a lot of companies that are unicorns, so valued at billions of dollars, and many of them I invested in their earliest rounds when they were just a couple people around a table trying to work on an idea.
That's remarkable. So look, I'm gonna give you a hypothetical. Well, actually, it's more of a matter of fact, right? So I, you know, am working on a tech company, right? And so let's kind of walk the audience through what that would look like, right? So it is a right, and no NDAs. If you need an NDA, it's not a good idea, right? Because if somebody can steal it, you don't
Yeah,
have the
yeah, and in
what do you
general, venture capital investors can't really sign NDAs, and they also wouldn't be particularly enforceable. An NDA is helpful if you are talking to somebody who generally wouldn't see the idea that you're working on. And I'm not a lawyer, but in general, NDAs are most helpful when you go talk to somebody who's sort of a direct competitor who otherwise wouldn't know about the idea. I, through I am inundated with pitches, and so whatever the idea is, I've probably seen 10 or 20 other companies, doing something similar, something that could grow to become similar, and so even if I signed an NDA and then you felt like something went wrong and you tried to, sue me over it, then you go to court, and 1, this is incredibly expensive for you, a founder who just wants to build your company, but 2, you go to court and you say, "Hey, I think Sarah stole my idea." And I say, "Well, it's not just your idea. Here's 20 other pitch decks with timestamps that I already had that when I saw yours," right? And then the judge says, "Okay, case dismissed, and now you pay Sarah's legal fees." And so, I understand the feeling of, "Oh no, what if somebody takes my idea?" Ideas are not particularly novel. What tends to be novel is execution and building and focus, and to some extent, just getting lucky. And so,
Yeah.
it's not something that people in venture will typically do to sign an NDA for an early stage company.
Well, that's exactly where I was going. I was literally saying I wouldn't even if I needed you to even sign an NDA, I don't have something that the next person doesn't have, right? And I think that's kind of where I was going. And so once again, let's kind of walk the audience through how maybe your business will work. So say I'm coming to you with a company that does debt mitigation while using AI to optimize and help users get out of debt faster and find ways to lower interest rates and get out quicker, right? Quick, terrible elevator pitch. However, right, I built it on Replit. I would presume you're familiar with that, or just any other AI coding software. Um, what would make you say, you know what, I like it
Yeah,
for
I mean,
any
I
company,
think
but we could talk mine in
yeah,
particular.
yeah, no, this so in general, what you're looking for, is sort of understanding kind of why you, how is this going to become, a multi-billion dollar company, ideally in a space that is, a multi-trillion dollar space, right? And so what does a multi-trillion dollar company look like? Say in general that companies will have a 10x revenue multiple, just because that's an easy way to think about it. Some are much lower in retail. It's more like in e-commerce, it's more like a 1 to 2x revenue multiple. So, when Zappos, the footwear company, sold to Amazon for $1 billion, they were doing $1 billion in revenue. That's a 1x revenue multiple. For a software company, usually that doesn't have to hold inventory and everything, you're hopefully looking at a 10x revenue. So to be a $1 billion company, you have to be doing 100 million in revenue, which means that you either have, 100 million customers paying you $1 each once, right? Or significantly fewer customers paying you much more money on a regular basis. And so once you're doing that 100 million, then that means that you're a $1 billion company. But it's really hard to be a $1 billion company in a $5 billion space. That means that you're 20% of the total addressable market, right? Either in your country or worldwide or whatever. What it's a lot easier to do is to be a $1 billion company in a $1 trillion space, because that means, hey, you're still a big company. As an investor, I might be investing at a 2 or 5 or whatever million valuation, but I can still make a ton of money because I can see a path where you can sort of mess up everything, hit lots of bad luck, and still become that $1 billion company. So that is what I'm always looking for, what every investor, venture investor is looking for on the sort of outcome side. Now the question is sort of, how do you get there, and what about what you're pitching makes that specifically exciting? I think a lot of it has to do with sort of the why you, why this, right? So if you mentioned AI coding platforms, it is absolutely fine to use that sort of stuff if you're building something that doesn't require a ton of tech. If you're building something that requires a ton of tech and proprietary patents, you're probably not going to get there if you personally aren't a super experienced coder who knows how to do that, right? So lean into your strengths, right? If you used to work in finance or a hedge fund or a bank or whatever, and you know a ton about underwriting debt, and you see this like really obvious sort of gap in the market that everybody's always missing, and you say, okay, great, how do we make that work, right? How do we make that better? You don't necessarily need a ton of tech. You can build some of it off the shelf initially, and for your sort of minimum viable product MVP, and then you can hire engineers later. But what you do have that is really important is a deep knowledge of the space. And so the why this is, hey, this kind of debt is a multi billion trillion dollar problem. Here's the knock-on effects. Here's what's happening to people. Here's why we need to fix it. And here's who will pay for it, whether it's the individuals or companies or whatever. And here's why I'm a good fit for it. I've worked in this space for 5 years. Or you typically see people have either education, lived experience, or professional experience in a space. So maybe you have a lot of experience because a close family member was in a similar kind of debt. Maybe you got a master's in finance, and your thesis was on this topic. Or maybe you worked at a bank for a long time in this space. If it's not any of those things, it doesn't mean that you will be a bad founder. It just means that it is probably going to be a tough business for you to run and scale and get funded. And you might want to think about, what do I know? What can I lean into? Where's the Venn diagram of, here's what I know really well that's also really valuable in the marketplace, and what can I build there?
I love it. I love it. I mean, I was getting ready to start, giving my elevator pitch and saying why, but we're going to take a quick break. And when we come back, we're going to have more with Sarah of Cleo Capital. And she's going to tell you guys how she can help scale my business to a unicorn. All right, guys, welcome back to Financial Freestyle. And we're having an amazing conversation with Sarah. I'm going to stop hijacking the conversation because I was going to literally keep talking about my company. And by the way, we're going to have to talk about this offline. But I do want to get a sense of kind of what are some of the new emerging technologies that are keeping you busy and, more importantly, keeping you excited?
Yeah, so I've been spending a lot of time lately focused on cybersecurity. It is wild every time you get one of those text messages that's, somebody saying, "Oh, trying any way they can think of, right, to try to scam you. It's your boss, it's a new job, it's a housing thing, it's a date, and all of them are often fake. And what people are actually doing is trying to, find a way to get you to talk to them, trust them, click a link, give them information, so that they can scam you. And so I've gotten really focused on that space, particularly for consumers. There are lots of cool companies like the CrowdStrikes and Palo Alto Networks of the world that do a good job of protecting big companies from scams and hacks and ransomware. There are very few things that exist to help protect, you and I on our personal phones and in our personal emails from those kinds of things. And so, I've gotten really, really focused on technology building for that.
Actually talk about kind of your investment process, especially in times of, you know, uh, uncertainty, right? I think right now we're in the midst of a few things from a political backdrop standpoint. Does your investment strategy change at all in times of uncertainty?
Yeah, it tends to there's different kinds of uncertainty, and the kind of uncertainty we're in right now is sort of a macro uncertainty. So, you look at the stock market every day when you glance at a terminal on Yahoo Finance, whatever, you want to be seeing green, right? Right now we are seeing a lot of red across a bunch of different categories. And what that typically means is when the stock market's not doing super well, you are likely to have fewer new companies IPO into the stock market, do an initial public offering and go public. And then because of that, it means that venture investors like me, we're not getting those early investment dollars back because we tend to get them back when companies get acquired through an M&A process, which has also been slower, although that's picking up a little bit, or when there are initial public offerings. So when we're not getting our money back, we have less money to deploy and to invest into new companies. And so, you'll see that funds have raised millions and millions of dollars, even billions of dollars for the really big ones. And you think, wow, they must have so much money. But compared to what was happening, a handful of years ago in terms of fundraising velocity for funds, there's a lot less money. And so, because of that, it definitely has slowed down overall the speed at which most venture investors are writing checks. And then when that slows down, even if you personally feel like, oh, I still want to go find great deals, smart people tend to behave rationally. And so if smart people know that it's a harder time to raise money, they're less likely to go start a company and go out and raise money, which means that the opportunity set for an investor to choose from can also be a little bit smaller. And so there's just sort of this cyclical effect of a slowdown means a slowdown means a slowdown that we certainly have been in the last couple years.
Let's talk about some of your best investments, and then more importantly, let's talk about some of your losses. From not obviously mention the names or anything, but I want the audience to get a sense of like kind of what you do, and then more importantly, kind of your process behind it.
Yeah. So we'll talk about I like bad news first. So the some of the so for the companies that haven't done as well, we have a saying in venture, which is you can only lose money once, right? And so it's sort of like that Charles Dickens line or whatever that every unhappy family is unhappy in its own way, right? The reality is that if your company fails, if you lose money, your company doesn't necessarily fail. There's so many ways to lose money. There are people who their company will have great success, but because there is a difficult fundraising round a few years back, and somebody had a investment note or some debt that had senior preferences or ratchets where they were getting 4 times their money back at a certain valuation before anybody, including the employees, could get any money back in the smaller, earlier shareholders. It is normal as an earliest stage investor to have a company that does well and makes money and has an exit, but then you individually don't. And that certainly happened before. And it's just sort of part of the ecosystem and part of what happens. And then you also have companies that fail. And I've had companies that have failed because the founder has gotten really sick and can no longer be the CEO, and it's a little bit too early in the company's life cycle to just sort of successfully stick a new CEO in, and so it's had to sell or shut down. I've had companies that have failed because the founder just decided they don't really want to run it anymore, and or they want to pivot to something that just is a bad idea or even bad timing. Certainly during 2020, 2021, lots of companies were victims of COVID, and even coming out of it, were victims of their own success during COVID. So I was in a grocery delivery startup that was doing really well during COVID, as you can imagine. And then as that tide turned, they ended up going out of business because they struggled to raise more money, in large part because the trend, this mega trend that took over all of our lives for 2 years, had dissipated, thankfully. And that meant that there was a question mark about sort of how big the opportunity would be going forward. And so, you know, companies fail for so many reasons. And the way that you sort of underwrite a venture fund for me is I assume that I'll have one hit for every at least 10 failures. It's normal in a venture fund to have one company that makes 80, 90% of the money for the fund, and everything else, barely moves the needle. And so we call it the power law. And that's sort of just the reality in our industry. And so any VC who tells you they've never had a failure is either lying or they don't write many checks, because the goal is you will back a bunch of things that don't necessarily turn out well for you, because you are risk capital. And so you want to be in a higher risk environment.
Thanks for sharing that because I think that is pretty interesting. I think the venture space is one that is ever evolving, and seeing you being someone uh, that's crushing it, congrats to you. If we can reflect, what would you say to an 18-year-old Sarah if you could go back in time?
I would say that make money, make money, make money, and not just for sort of the purpose of making money, but make money to invest it, right? If you already have a lot of money, great. If you do not have a trust fund, one of the most important things I think you can do when you're young is take any extra money that that you have, that you earn, that you make, that you get gifted, and you're at a bar and somebody buys you a drink, put that $10 into the market, right? Into an ETF or index fund, because the one of the sort of miracles of finance is the long-term compounding interest, right? In the time in market. And so the earlier and sooner you can put more money to work, putting $1,000 into the S&P 500 when you're 18 is worth probably $10,000 more than doing the same thing when you're 40. And so those early years when you can live off of ramen anyway, any spare dollar you have, invest it. Any spare dollar you earn, invest it, because it pays off just in huge ways as you get older, because then you have a lot more freedom, because you have a much bigger financial cushion, and you don't have to sort of keep working jobs you hate or doing things you don't love, because a relatively modest amount of money gets much, much, much bigger over time if you index it and forget it.
Sarah, thanks so much for joining. That's it for this episode of Financial Freestyle. Once again, thanks to Sarah of Cleo Capital. And guys, make sure you tune in next week here on Yahoo Finance.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.